All right, what's going on, everyone? This is Equanimity, and this is episode number 2. So, I know I said that I would usually make a video every other week, but I thought this was something very valuable and could be useful to a lot of you. So, I'm really excited for what's in store. Essentially, what this video is going to be about is showing you actually how to find high quality businesses. I'm going to give you an entire rundown of my whole approach, especially early on, to help you get started and get a good foundation, and then where that has progressed overall. Now, I do got to look back. Episode 1 was last week, and, we hit 34 views. So I'm sure about 3 or 4 of them were me, probably 2 or 3 were my wife. Maybe my mom was in there. So, but for anyone who did watch it, really appreciate it. And, ultimately, I think this is a good opportunity to set some goals for this channel. And I think the first one is to hit 100 subscribers and 1,000 views on one of these videos. So if you want to help out by liking, sharing, subscribing, doing it all, I really appreciate it because it helps grow the channel. And then we can also ultimately help reach more people. So with that, what am I going to do here? I want to provide you with kind of my framework and how I came about finding all these companies. Again, a reiteration of the last episode is that I only focus on investing in individual stocks. I think you get higher returns and you can find a lot of high quality businesses that mitigate risk overall. So definitely worth it. And I'm going to give you the rundown today. Now, what we are going to do throughout this episode is I'm going to take you through the process of how I find these companies. And then on top of that, we are actually going to pick 3 companies to join this list of 80 or so businesses that have already made my watch list. So in other words, we are not leaving today until we find 3 quality stocks to add to the list and hopefully one day maybe invest in them. Now, I also wanted to do something. Again, this is my channel, so I can do whatever the heck I want. And I thought it would be fun that each time we make one of these videos to be able to check in and see where the top quality and highest ranking companies are standing today. So I have already refreshed the valuation metrics. So that would be free cash flow yield, as well as the over under tied to the company value relative to the market cap. And now I have re-ranked them and set them up so that you can now see the new list of it looks like top 30 right now, top 20 to 30. So as you can see, the top 10 stocks right now on my list as of the week of, let's say, December 13th is coming in at number 1, Euroseas. At number 2, Copart. At number 3, Fortinet. At number 4, Medifast. At number 5, Nvidia. At number 6, Regeneron Pharmaceuticals. At number 7, Arista Networks. At number 8, Houlihan Lokey. At number 9, Adobe. And number 10, Primerica. So you can see one thing to keep in mind is that I do not revalue all the financials until the 10Ks come out. So you kind of have to wait for major updates from that side of things, but at least from a valuation standpoint and how that relationship between value and quality is built here is these are the top 10 companies right now on the list. So with that, how the heck did I actually find these businesses? So to start, I kind of want to give a rundown of the general suggestions that a lot of people hear. You'll often hear that you should buy what you know, and that can be or come from many different angles. So one could be that you are a consumer. So obviously a lot of people own Apple products or they use a Microsoft laptop. Maybe you purchase a car like a Tesla, or you shop at Costco or Walmart. Those are all a good foundational base, and it's an easy way that, again, you're already shopping there, so you might as well invest. Now, what I have found is that is a very good starting point, and it starts to get things rolling where you're thinking about investing and what makes a good company. Where you can run into trouble is by only shopping what you know, you're also really limiting your scope of all the businesses out there. And what you're going to find, especially if you do dive into really stock research, is that there are thousands of companies out there and decent ones that you may never heard of. Going back to last episode, I talked about Euroseas. I have never been a shipper of or a customer of a shipping company that operates in the Eastern Hemisphere, but by being able to discover this company, I was able to see that its financials were fantastic. Its business had a really strong and competent management team. And then on top of that, it was trading at a really attractive price. And once again, this creates a lot of value. I was able to generate about 114% return since just this April. And it's just one of those ideas or examples where you can really find some good companies out there that you may not know about. And so don't limit your scope just to businesses that you truly understand from a consumer standpoint. Just to build off that last point too, so obviously consumer is the major one that they talk about, but you could also work for the company or work in the industry. You could also be very passionate about something, and usually any one of these kind of coincide with each other, but those are all good reference points for at least trying to find companies to start. Now, from there, what I ultimately did is, again, I wanted to kind of cast my net as wide as I could for a couple of reasons. One is to expose myself to as many companies as possible, but I think it's also really advantageous for you to understand and learn about different industries and then ultimately see what makes a good business operating in a solid industry, because there's some tough industries out there. And, in the past, I've always referred to the airlines as one of them because it is a very high expenditure business where it takes a lot of money to operate. And, especially with planes, like for a company like Boeing, for example, they have a monopoly, but they barely make a profit. And sometimes they even lose money in a year just because of how costly it is to build these planes. And then not only build them, but maintain them. And then what are you going to do if demand decreases? You're in a really tough spot. So that's just an industry where, even though Boeing, again, a monopoly essentially, like especially in the West here, it's still very difficult, and they're probably a monopoly for a reason, just because other companies or other people don't want to pursue that business just because it's so damn difficult. So that's one thing to think about here. But the other part of it that I think is really useful is that you also will start building connections and patterns across different companies that you may say, hey, well, if NVIDIA builds these GPUs, well, who actually goes into the back end to that? And you'll learn about how TSMC develops 71% of the most high quality semiconductors. Well, why are they able to do that? Well, a lot of it has to do with ASML's ultralithography machines. So, there's connections everywhere, and that's what you start to learn and develop an understanding of, and then you can really see what the best businesses are. But to be clear, that's not necessarily where I started. I started at ground one. I was trying to figure out, how do I actually invest? What makes a good company? All of these things. And so that's kind of what the essence of this video is going to be about today. So, first and foremost, I kind of want to lead you with where I began and my approach. And so that starts with the Rule 1 playbook, okay? So before I even get into what I actually did here, I want to give a shout out to Phil Town. Now, when I was starting this whole thing, it was actually his book, Rule 1 Investing, that really got me on this trend and put me in the right direction. Started talking about quality of businesses, how to actually calculate and figure out what quality can be measured by, and then also to figure out what businesses are worth. And I wish I don't have his book right now, but Rule 1 Investing, I highly recommend it. They also did with his daughter, Invested, which is another very similar book overall, but it kind of takes a different approach in explaining it. Both of those two books are top notch, and really anyone who's trying to understand investing should be reading them, because you're going to be set on the right motion. So in addition to that, ultimately, once I jumped on this bandwagon of trying to invest and figuring out what the heck it was all about, I dove in head first. So not only was I reading those books, but other ones, I was also listening to the Rule 1 podcast, because I think it's just a reinforcement where if you can expose yourself as much, you're going to be thinking about it more often, and then you're going to be on the right path. So that's where I started. Now, and a little shout out, and to be clear, none of these websites or anything are sponsors. These are just truly my approach when I got started, and I think it should be helpful. Now, I do realize I pulled up their website, and before at least, I thought they had a calculator that essentially calculated just the quality of a stock as well as its price. And so I think the website has changed a bit, but I did want to give them a shout out, at least their website, because there are some very useful tools here as well. So sticker price and MOS, that's essentially how you calculate businesses. Again, going back, we got ROIC. I've been a huge proponent there. Operating cash flow, as I've talked about. And then, payback time will give you another idea of like how much time it takes to actually make back your money, essentially, if you bought the whole business. So all good, useful tools that I think, I didn't necessarily use these ones directly, but I did get started using their website to figure out these businesses. And that's kind of what I'm going to show you next, but a little shout out here. So here's what I actually did. When I was first starting, I, again, had this idea of, okay, here's some companies that I think are useful, but I don't necessarily have a broad enough scope to where I feel like I'm finding companies, especially trading at a reasonable price. I knew about companies like Google and the like, but I didn't necessarily think it was worth investing at the time. Kind of thought they were overvalued. This is, as you can see, 2020. And that's right at the, ultimately the peak and the swing of the post-COVID-19 bubbles. That's, I didn't necessarily think there was good prices. I wanted to expose myself to as many businesses as possible. So what did I do? Using this old quality calculator that was on the Rule 1 Investing website, I essentially pulled the Fortune 500 companies. And my goal was to go through all 500 of them and rank them by score. And so that's what I essentially did. And you can see at the time that based on whatever the calculator here, it gave me a quality score of each of them. So top of the list at that time was Alphabet, then CBRE, so that's the real estate company, Regeneron Pharmaceuticals, Facebook at the time, Nvidia, United Health, Ulta, Progressive Corporation, Micron, Ross Stores. So all really good companies. You could see their scores. And I also calculated their margin of safety. So that would have been what the price of their stock was at the time, or what their intrinsic value is, where you would want to have purchased them. And then I was ultimately comparing it from there. But this is kind of what it takes. It was a tiresome process. I went through a lot of companies. I think I ended up finishing with about 250 here. And, it takes a lot of effort. One way or another, what you're going to learn is that if you really want to be successful at doing this thing, is you're going to need to put in the work. And this can be very difficult. I work another job during the day, but you got to find ways to commit yourself and realize that this is ultimately for the betterment of your future. This is not something that you want to take lightly, and it also can pay off tremendously if you do put in the work. Now, there is a caveat too. I did get started with this in university, had a bit more free time, and so I spent a lot of that time trying to build this out and really strengthen my foundation overall. So, but starting Fortune 500 companies, that's a good place to look. 500 of the highest revenue generating companies, I think, all in the US. So, again, America has the largest and most productive economy at this time. And so a great place to look. You're going to find a lot of good businesses, at least on that list. And then the next part is to actually, you want to go and figure out what their quality is. Are they trading at a good price? Is it a good investment? Because that's the thing, is you'll be surprised is, you see companies like Alphabet and Facebook or Meta, Amazon up here, companies that everybody knows are really, really good businesses, trillion-dollar companies that are producing billions of dollars in free cash flow. But you also have to understand that there are some really, really bad companies out there that you would think of as top-notch stocks. And this is where exposing yourself, understanding quality, and then also where that relationship with price lands is going to help differentiate good businesses from bad and protect you from making bad investments. So you can see here, at the time, Citigroup was 250 out of, 251 out of 251 companies. It had a score of 14 at the time. Another, you can look at like Chevron Corporation, Halliburton, Goldman Sachs, the Kraft Heinz company, Macy's, so Oracle even, like these companies that a lot of people have talked about and even have reemerged as, highly hyped up businesses. But once again, you got to stay on top of quality. And I do want to note this was from 2020. Things have probably changed a bit here and there, but it's the general idea that you want to constantly be on top of how strong is the fundamentals of these businesses, because you never know, and you don't want to purchase into something that is ultimately going to burn you in the end. So just a good example there. Now, I'll kind of jump to another approach that I essentially did, and this again kind of extends back to the Rule 1 philosophy here. Bill always talked about is essentially having a punch card, and this is an extension of either Warren Buffett or Charlie Munger's philosophy, essentially, where you want to essentially have a punch card where, say even when you go to I don't know, like an ice cream shop or different loyalty places, they put a stamp on a certain spot. You kind of want to think of the analogy of, well, you only have 20 spots that you can actually pick. So you got to find the 20 best companies that you would like to invest in, commit to those, and then not stray away from there. And I've even pushed it further. Really, you only need 10 companies. If you can find 10 really high quality companies and buy them at a good price, you should be set for life. If you just keep investing in them over time and finding the pockets when they're trading at a reasonable price, you will be in a great spot. Now, that's it. 20 companies, also a good opportunity. So I think that's essentially what I did. This is early on here, again, 2021. It hasn't necessarily played out there this way. I've found other opportunities, whether from a quality standpoint that was higher or a better purchase price. But, right now we have about, I think, 9 companies in our portfolio. So, but once again, and that just goes to show I've been doing this thing for now about 4.5 years, where I actually started investing, and I've only found 9.5 opportunities that I thought were the best, truly the best opportunities in the world. And again, you're going to say no to 99.99% of things out there, and it's just a matter of finding those best chances at getting you the right amount of wealth without putting your money, your livelihood, your family's wealth on the line. So that's what I'm doing. Now, I thought this was just a useful idea going back to, but then another possible approach is to actually look at the best investors in the world. And so once again, this is old, but what I did is I essentially went and tried to find many of the, say, best known investors out there, people who have achieved success, and then try and make sense of what they invested in, even value some of these companies, and see if I agree or if I'd like to stray away. Now, one thing you'll notice with bigger investors, somebody like Warren Buffett, is that when you're dealing with hundreds of billions of dollars, it is a lot more difficult to find quality companies, because in order to generate a meaningful return, you have to purchase something that is of size and scale that reflects your own scale. And so what I mean by that is that if Warren Buffett, who operates a $1 trillion company, purchases a $1 billion stock, and even if he bought the company outright and that stock doubled or even tripled, it's not even going to put a dent on his returns. It is going to be less than 1% of a return. So he has to go and focus on companies like Apple that are also $1 trillion businesses that, if they even generate a, say, 30% return over a couple of years, and 30% in this example is $300 billion. Those are the types of businesses he has to look for. So you actually, as a smaller investor, have a greater advantage because your pool is a lot bigger. There's a lot more risks, let's say, but you can also expose yourself to a lot more companies and hopefully try and scale up. And one day, like me, hopefully reach a point where you're managing the type of money that Warren Buffett and others are doing. But I think this is a good example nonetheless. Warren Buffett here's portfolio at the time, Bill Gates. You can see companies like, Berkshire Hathaway, obviously, he's a big proponent of Warren Buffett, Walmart, Caterpillar, FedEx, United Parcels. Mohnish Pabrai, another really great investor, and one of Charlie Munger's good friends. So he was at the time at least only invested in Micron Technologies and Seritage Growth from an American standpoint. And then Carl Icahn, George Soros, David Tepper, Seth Klarman, Bill Ackman, Charlie Munger. So, it's just a good way. You can go search up all this information. It should be public for the most part, a lot of these investors, because I'm pretty sure if you're managing over, it's like $100 million, in the US, you have to go and disclose what you're publicly traded in. So it's all out there. You just got to go digging for it and go find it. I think Guru Focus is a good website for that. But again, nowadays, especially even with AI and Gemini and everything, you can just search up what is this portfolio. It should produce you at least a list of the companies, and then you can go do your digging to see if you want to invest in them too, or if you'd rather stay away. So just another good approach. Now, those are all ways that kind of helped essentially build my foundation, but it is not the main approach that I use to actually finding quality companies. The best and most effective way that I've essentially done it is I've used stock screeners where I set certain conditions, and then I want to go and look at each of those companies one by one and decide whether they are on the right track or not. And the most effective one that I generally used for most of these companies here is on a website called macrotrends.net. So why do I like this? Well, I think one, the screener itself is pretty simple. It limits it to a few, kind of straightforward filters there. But I also like the layout of how they present financial information. And that's because it'll provide, at least say 20 years of data, whether it's revenue, net profit, free cash flow, book value, all those things. And it kind of shows you in an ascending order to the most recent years. And what really I'm looking for with each of them is that I want that to see that they're trending in the right direction and growing ultimately exponentially. So you'll see that here momentarily, but again, not sponsored by macrotrends.net. If they want to sponsor me, that would be really sick, but this is just what I found is super useful. So I will kind of walk you through this process, and this is actually how we're going to find the 3 companies to add to our list. So first thing you want to do, we're not going to limit our scope in terms of market cap, but you can definitely do that. I do think it is reasonable to put a maximum on price to earnings ratio, because what this is doing is PE ratio is a valuation metric. It's essentially measuring the stock price over its earnings per share. And again, you want to buy companies. It's like anything. If you can get something at a discount, you are going to be much better off because you are purchasing below what it is truly worth and then benefiting from that price appreciation over time. And the fact that you've spotted that differentiation is going to give you added boost on top of the quality. And that's something that I've found a lot of the times. My best investments are actually when a stock has been punished unfairly by the market, the stock price has plummeted, and I've said, hold on a second, I think it's worth more than that. And I also think that it's a high quality company that I'll be protected. This thing's not going anywhere. And that's exactly what happened. Sometimes it takes 6 months, sometimes it takes a year, maybe a couple of years, but usually over time, your suspicions are right, and then you ultimately benefit and you make a higher return. So that's why we put price to earnings ratio. Dividend yield, I don't really care about dividends. We can talk about that at some time, but the general philosophy towards dividends is, if a company has to pay a dividend out, it's usually because it's a mature business where it's a lot more difficult to grow and they are accumulating cash and don't know what to do with it. I would much rather prefer that a company reinvest that capital back into the business and even not pay a dividend outright, because that way they're growing at a much higher rate. And realistically, a lot of these CEOs, especially of high quality companies, are probably going to be better investors and capital allocators than you as an individual. So let them do the work. You don't need to go and use that dividend money to go and find new stocks. Let them just grow it for you inside the business, and you usually are fared off a lot better than that. Best example of that is Berkshire Hathaway, where Warren Buffett has paid in 65 years, I think, 1 dividend, and he still regrets it. So he's a guy who's grown annually, or at least Berkshire Hathaway has grown annually at 19.8% per year, and the average over that time is like 10%. So he's more than doubled the performance. If you invested with him, never got a dividend throughout all of it, you'd still be better off than 99% of investors. So best example there, but I don't really care about dividends, so we are not going to highlight it. Once again, price doesn't matter too much. Price to book value, another valuation metric that essentially says, okay, here's the price of my shareholder, or the value of my shareholder equity if I purchase it at this price. And so what essentially, this is, I think, just a good example to go through, is if it is less than 1, so essentially the price is below the amount of book value in the company, well, then you're essentially, what you're doing is, if the business ever were to go bankrupt and had to liquidate everything, it sold off all its assets from tomorrow, it was no longer a business. Well, if you purchased it below a price to book value of 1, you'd actually be getting a return still on your investment. And, this rarely ever happens. And this was actually the strategy that Warren Buffett and Benjamin Graham used a lot, is the cigarette butt investing approach, where essentially they were finding companies that traded below their book value, and then they were pushing, especially at their size, to try and liquidate them, sell off assets, and get a return, because they knew the company, or at least the price and value of those assets, were higher than what the market was valuing them at. So just another approach, but not really as useful as, I think, PE ratio or a discounted cash flow model that is ultimately the best valuation tool that I've found. But just something to keep in mind there. Another one is long-term debt to equity. So this is one we do care about, because what it's essentially doing is it is telling you that how much debt they have relative to their equity or book value. Once again, what you want is, debt is okay. You can have some debt, but you do not want excessive debt. And so in this case, I want to even see if they can. Yeah, so you can't even go to past 1.0, but I think 0.5 on this filter is reasonable. You don't want to exclude every business, and really a lot of most companies use some debt. The best situation is if they use no debt whatsoever, because that means that they don't really necessarily have to pay anyone beyond the actual operations of the business for the most part. There are certain liabilities here and there, but if you have no debt, you don't have debtors who are seeking out payment constantly. And obviously, if you're profitable, no problem. But if you're not profitable, they can be breathing on your neck, wanting their money due. And if you don't have it, then they're going to push you into bankruptcy. That's how you lose a lot of money in investing. Last one, return on equity. So this is an extension of return on invested capital. The only difference is it does not have debt as well as in the denominator. So it's a less conservative metric. This is actually the one that Warren Buffett recommends. And he always advises a return on equity of 10% or greater. Well, let's take that to the next level. Let's put it at 20%, because why not? We're trying to go for top tier companies, and we are going to try and find just that. So, there's a couple other filters here. You can do the operating margin, net margin, and really we will put a net profit margin, because I think it is a good idea. It also helps differentiate profitable businesses from non-profitable. Return on equity should do that as well. But you can see other ones these ones I don't really care about. Price to cash, maybe. Price to sales, less so. I value sales a lot less than profit. These ones, so this is the forward PE. So this is essentially calculating and factoring in growth into the future, what that price to earnings ratio should be. And then, or maybe that's this one. Anyways, see, I don't even know what I'm talking about when it comes to these two. Less important. Return on assets is, I think it's just a bad reflection, because you can have a lot of assets and it'll be a lower number, but it also, you could just buy and buy and buy and buy and buy assets, and one way or another, the return is going to be smaller. So I would much rather something like return on equity that factors in how much remaining assets you have after all your liabilities are paid for, the true ownership that exists there. EPS change 5-year could be useful. Sales change 5-year could be useful. We're going to skip it. This is performance. I do not care about this, and neither should you. And then this is nonsense that is taught in financial schools, including, say, at the time when I was learning about it in university. I do not care about beta. This is what professionals will push on you all the time. And beta is a measure of risk, but all it is checking is how much it deviates from the average. And a lot of good companies or a lot of attractive investments will deviate a lot more. And you want to buy them at the lower end of that. But this will essentially, and what most professionals will tell you is that, oh, if it's a higher beta, it's riskier. Well, again, not really the case. So anytime you hear about beta, you should laugh and question what they are talking about, because it is not going to be helpful. So now that I've gone on that rant, what we can see here is we've actually found 84 companies that fit this criteria at this time. And this is a good chance to start looking at these businesses. So what I would do is, from this point, is now that we have the list, I would go one by one and I am going to look at the business's financials. So hopefully my Wi-Fi is good, but what we are going to do is I'm going to check with each of them. So first I clicked on revenue. Again, what you want to see is that this is on an annual basis, this is trending upwards. And interestingly enough, the first company we're seeing here, Novartis, is their revenue is essentially flat. So in 2010, they made $51.5 billion. In 2018, they actually only made $46 billion in sales. In 2024, they are back at $51.7 billion. So in the span of 14 years, Novartis has actually only grown their sales by $200 million today. And I don't know what the valuation of Novartis is, but my guess, it is a $100 billion company. And for that kind of growth and fundamental strength, it's not a good sign. But we're not going to discount it quite yet, because like I said, and I've kind of reiterated, is that sales are not necessarily the most important thing. Oh, no way. You've reached your free limit of 10 pages this month. Well, this puts a dent in my plan. This has always been free. This is interesting. So we are actually going to use a different approach. This is not going to stop us. We have found a workaround after it turns out that Macro Trends is starting to charge for research now. I mean, fair enough. It is a business. You gotta make money, but that is definitely disappointing, because that has always been a super useful tool. I'm sure it still is, but that definitely puts a dent. But always just different opportunities to be able to search for companies. Don't feel like you have to be committed to any one website, because there's a lot of information out there. And so a prime example of this is barchart.com. And I actually, in many ways, do prefer Barchart to Macro Trends, just because they provide a lot of good information as well. It's just not visually as laid out, say, as smoothly always, but you can see here they have tons and tons of information. So I've always been a big fan of barchart.com as well. Hopefully they don't start charging for everything too, because then I'm going to have to find another alternative and keep bouncing around. But that's all good. So now that you have the viewing set up, I just want to go reiterate kind of what I was saying quickly, make sure we're on the same page here. But what I essentially did, barchart.com, and then I was highlighting just all the information they have here on the left. And if you scroll to the bottom, you can find the financials there and search it out right here. So we are looking at Novartis. One of the limitations, I guess, with barchart.com is that you can only see 5 years of information at a time, but you still can go all the way back, which is the main goal. Is if you can find at least 10 years of financial information, you're in a great spot. So we'll look at Novartis here. We talked about sales, how they really haven't changed all that much in the span of 14 years here. Well, where you can see a bit better growth is in terms of profit. And it's fluctuated year by year. Like in 2020, they made about $8 billion in profit. 2021, big year, $24 billion, and then down to about $12 billion. And, you do want to see, the ideal situation is that profit is increasing every year, but that is not always something that is possible, and it's not as big as a worry as long as you continue to generate a high return on invested capital and your fundamentals are improving overall. One way or another, profit is essentially you retaining capital afterwards that can be deployed. So depending on the economic state, sometimes, your costs get higher and so your profits can be tighter, or maybe the economy flounders and you still have to pay for things, but your sales kind of diminish a bit. So any one of those things can drive it. But that said, the best situation is something that is constantly growing. So, what I would see here is Novartis, solid, like profitability is kind of fluctuating. Their sales growth has really not grown that much, which is not ideal, but they are in a decent position overall. So next, we would want to look at primarily their book value as well as their, get this thing out of the way. We want to look at their book value as well as their long-term debt here. And what we would want to see is that they're paying that down. So you can see here on the most left metrics are 2024 to 2020. So first coming up here, we can see long-term debt. So they had in 2020 about $26 billion in debt. This has come down to $21 billion, solid payoff overall there. Nothing really to worry about, especially with the amount of profit that they generate overall. They could pay off all their long-term debt if they wanted to in just a couple of years. Then shareholder equity here. So this is a number that we want to see generally improving and strengthening, and we are not seeing that in this case. So over the past 5 years, they had $57 billion in shareholder equity. This has dropped now to $44 billion in shareholder equity as of 2024. So things, what I would do at this point is I would say this is a decent company. They certainly are making a profit, but there are better opportunities out there, and you don't want to necessarily limit yourself to a company like this that is kind of trending in a wavering direction. Things are not necessarily certain. Are they improving? This is the questions that you have to ask yourself. So I would actually move on from this point. And so we're going to bounce back here. The next one is Uber. So Uber's an interesting business. For a lot of the 2010s, they were not profitable. They were gobbling up market share by operating at a lower price until they essentially disrupted the taxi industry outright. They've gotten into food services now and grocery delivery services, and this has allowed them to solidify, at least in consumers' mind, them as one of the default and arguably the best player in transportation of food. Back when I would look and gathered most of these companies early on, is I would have taken a pass on Uber. But now what we're seeing is perhaps a different story. And, I'm also referencing information that I've tracked over time studying them. But, ultimately the numbers aren't going to lie. So what you see is in 2020, Uber made $11 billion in sales. At that time, they were losing about $7 billion annually. So that's a lot of money to be lost, and at that time, it's fair to be kind of skeptical of whether it can actually turn itself into a profitable business. But here's where it gets interesting. In 2020, they had 11 billion. 2021, 17 billion. This grew in 2022 to 32 billion, and as of their last full year, they are now at $44 billion in sales. But as I said last video, sales aren't everything. If you keep growing sales but your losses continue to mount, you're just putting yourself in a tougher position where in order to sustain that amount of business and demand, you are going to have to spend a lot more money. And if you can't find a way to turn a profit, you're going to be in trouble. But what we see here, 2021 profits, about $500 million loss, not bad. 2022, that huge loss of $9 billion. But in 2023, they achieved profitability for what I believe is the first time. Now they generated about $2 billion in profit. But look what happened in 2024. In 2024, they produced about $10 billion in profit. So they went in the span of 5 years from losing about $7 billion to to making about $10 billion in profit. That's a $17 billion swing. And now they are at a point of sustainability where they are bringing money in. The big thing, and I think this is a good visual, is when you see losses, that means that a company is going to have to raise money elsewhere in order to stay afloat. Because as soon as their cash dries up and they have to pay all their customers and pay for their technology and their infrastructure and all these different things, they're still going to need to find a way to do that. And if they aren't making a profit, then they have to go raise outside money from investors, which dilute shares, or they have to take on debt. When a company is profitable, that means that they can do it in-house. They no longer rely on outside money. They no longer need to dilute shares as much, and they also no longer require debt as much as well. So the best point to be at is a profitable company, because then you are self-sustainable and everything kind of improves from there. Now let's move on to the balance sheet and see if that is reflected in their assets and liabilities as well. So I do want to note, actually, just while I'm looking at it, another useful piece of information to look at is cash and marketable securities. So this is immediately the liquidable cash that they essentially have that they can deploy at any time. There's not really any restrictions. So Uber has about $6 billion in cash. This is what I talk about. If a business is losing money, they're not profitable, you'll see this start to deplete over time, and they'll be running out more and more. And then they'll reach a point where, okay, they only have so much. They're not going to be able to survive the next year or quarter. They need to go raise more money. But a profitable business, usually the cash pile is growing, because as they build their sustainability and durability, but as well as they try and find new investment opportunities. Moving on to long-term debt, at about $7.5 billion in 2020, and this has grown to about $8.3 billion. So again, not too concerning. The company did make $10 billion in profit this past year, so they're already on a good trend, and they could pay off all their long-term debt in 1 year if they wanted to. So that just means that long-term debt's not too excessive or in excess. And then this is a really good sign here. What you're seeing is their shareholder equity book value, $13 billion in 2020. This has grown to $22 billion as of 2024. So just based on first glance, I think that Uber has really turned themselves around and positioned themselves way better than I could have imagined, especially a few years back. And, you could say that's a mistake in my judgment, that I didn't foresee the future, but ultimately, the numbers are not going to lie, and your best protection is finding companies that have already proven that their fundamentals are strong, they're sustainable, and then ultimately buying it at a good price. So with that, I actually think that we will add Uber Technologies to the list. And I won't actually build out the calculation today, but what I will do is I will add them here, and then come next episode, I will provide you a breakdown of where I think their financials are at today, if they're a good investment, or if you should hold off. So now that we found company number one, we can keep moving on. So PDD Holdings, Pinduoduo, is one of China's largest internet commerce companies. They build some, I'm trying to think of their businesses, but I'll have to provide a more thorough detail, but I've actually looked at them in the past, and we're going to look at where the financials are right now and see if it is worth investing. But from what I remember it being a pretty solid company overall back then, and we will see if that is still the case today. Okay, so we are back, and it is pretty much as I expected. PDD, I think this is a company that Michael Burry invested in, a couple others, at least at some point anyways. And I'm really I can't remember right now, but I will provide more details in the next video, because we can already tell here that this is a really solid business overall. It speaks to everything we were talking about before. Sales in 2020, we had $9 billion. This has jumped to $54 billion in 2024. In a 5-year span, they've almost quintupled their amount of sales, which is unreal, okay? But this is further reflected in their net profit here. So this line here, they were losing about $1.1 billion in 2020, they actually turned profitable in 2021, $1 billion here, $5 billion in 2022, $8 billion in 2023, and now they're at $15 billion of profit annually as of 2024. So major growth, huge acceleration. this is a company that already has piqued my interest before even moving on to the other elements of it, just because of how strong they are. Now, there are elements ultimately, like one, you'll find that there is a home base bias, which essentially means that because, say, if you either live in Canada or the US, you're actually going to be more comfortable investing in companies from those countries. But don't limit yourself. It is worthwhile at least exploring companies from other countries. There are definitely, different circumstances depending on where you invest and things you want to be aware of from a regulatory standpoint, how companies actually have to report their information. So I'm always going to be a little bit more skeptical when it comes to companies from other countries, just because, again, I'm not as familiar with their process, but it still is worthwhile to look at. And Pinduoduo here is a great example of that, just because you don't want to discount a company that is so strong just because it's from another country. Give it a good opportunity. And, even what we're seeing here is it doesn't actually appear like they have any long-term debt. So you can see the way a balance sheet is broken up is by current liabilities and non-current. Long-term debt should be in the non-current liabilities because it's going on beyond a year. And what you're saying is none there. And even their other non-current liabilities right now is only at $437 million. They brought this down from $2.2 billion in 2020. So they are trending in the right direction, really, like better than most companies I've seen for the most part. And then with confidence, you can kind of tell from that point that this should also be reflected in shareholder equity. So we're seeing $9 billion in 2020. This grew to $43 billion as of 2024. So you know what? From what I've seen already, I'm impressed. This is even better than what we saw with Uber. We're adding them to the list. And now let's see if we can find our last business here. So we've done Uber, PDD. I've actually already pulled Progressive. So if you ever want me to dive into that, you can ask there. We could go into Travelers. So another property, casualty, and title insurance company. So I don't know too much about Travelers, but this is a financial analysis at this point. So what we are going to do is, if this company joins our list, I can provide more details in the next video. Now that we got Travelers information loaded up here, we can kind of dive into where they're at. So first things first, sales seems to be trending in the right direction. In 2020, they had 32 billion. In 2022, this grew to 37 billion. And as of 2024, they are at $46 billion annually in sales. This is also reflected in their profit. So they had $2.7 billion of profit in 2020, $2.8 billion in 2022, and $5 billion in 2024. So again, companies grow at different clips. And, a company that does grow faster can be much more attractive. But the big questions that come about it is that you may run into situations where it is more difficult to predict the future. Are they going to continue growing at that rate? That said, growing at a great clip, even if they, cut that growth in half, they're still going to be in a good position. The thing that you'll find is a lot of the time when you're looking at these really fast growing companies is that the market has already priced in and often overvalued them because of how attractive and interesting those companies are. So, a lot of this you'll see this a lot with technology companies that grow usually above 20% annually, is the price of the stock is just so overvalued that it makes it really difficult to invest, because I would love to own these businesses, but because the market has them so overpriced, it's not worth it. Sure, maybe it'll grow for a little while longer, and it can grow for even a couple of years, which is a good position. But really, as an investor, you want to be looking on 10-year time frames. Can I own this business for 10 years and have confidence that I'm going to generate a good return? And in a lot of the time, I just say no. So that's where perhaps, and I'm not saying the Travelers company is the answer here, but you can see that a bit of a slower growing company probably is not going to be valued as attractively. But if you can find that at the right price, you're going to make some good money. So trending in the right direction between sales and net income, decent. Go on to balance sheet here, and we can look here. So we can see that they had about $6 billion in debt in 2020. That has grown to $8 billion in long-term debt in 2022 or 2024. So, a decent amount, but not overwhelming. They are still a profitable business. They made $5 billion in profit in 2024, so they could pay off all their debt in 2 years if they wanted to. So not a huge concern, just another fuel and engine for growth. You just don't want to see this trend continuing and starting to escape them. The last one here is shareholder equity, and this one is actually interesting because they had about $29 billion in shareholder equity in 2020, and this has actually fallen to 28 billion as of 2024. So it's not the end of the world. There are companies that do reduce their shareholder equity at certain points, and Apple's a prime example of that, and still generate a really high return on invested capital. But you do want to ideally see everything trending in the direction. And because we're being critical here, and this is an example, I'm actually going to take a pass on Travelers just based on what I think is potentially out there. Okay, so we took a no on Travelers, but we are going to move on to the next. And it looks like it is Allstate, so a major competitor of Progressive as well as Geico, but Geico's private and owned by Berkshire Hathaway. So if you want insurance exposure, those are a couple of ways to do it. But let's take a look at Allstate. They've definitely built a decent brand. Constantly see their commercials when watching football games, and we'll see if we can get them here, their financial position, and see if we should add them to the list. Okay, so looking at Allstate's financials, first we'll look at sales, and we'll see that in 2020 they had about 42 billion. This has grown to 64 billion in 2024, so definitely some decent growth there. Moving on to net income, they actually generated about 5.6 billion in 2020, and this has wavered down to 4.7 billion dollars. And throughout that you see 2 years of losses as well, and so why an insurance company might run into situations like that is that they're taking on more risky premiums, and more of those paid out for whatever reason. You see, especially if it's, say, they're business insurers, and I don't know enough about Allstate to say exactly what they insured at this time, but what I would say is that you run into different situations, and that's one of the risks with insurance companies, is ultimately you want to stay in a position where you have a very strong relationship with the people that you supply premiums to, and you want to be able to assess risk effectively, where you're not taking on unnecessary pieces, but you're also ensuring with those higher risk situations you can make more money. And the best thing that you'll find with insurance companies, and this is really why Warren Buffett purchased Geico, and what he learned is what you do is, well, every month, every household and every business pays you money for that premium, and they only require it when they need that money back for whatever that risk is. Now, what happens with all that cash in the meantime is that the insurance company gets to go invest it. It's essentially a float. And so all that excess money, if you can grow that at a higher rate, then you're essentially making profit on money that's just sitting that you need to hold around, but you can just keep investing that. And yeah, if you do that at an above average rate, you're going to grow exponentially. And that's exactly what Berkshire Hathaway did. Is once they purchased Geico, they had already purchased National Indemnity and a few other smaller insurance companies, but Buffett realized that if he could use that float and invest it at a high clip, that he was essentially getting free money that to go invest and buy things at larger scale, and he did that better than anyone. And that's why Berkshire Hathaway over 65 years has grown by 19.8% annually every single year. So getting back on track, just wanted to explain a little bit more about the insurance industry. But what we're seeing here is flat to kind of underwhelming performance with net income. So we'll go on to balance sheet here, and what you'll see here is that they actually have long-term debt of 7.8 billion in 2020. This is growing to 8 billion here, and they're in a similar position as Travelers overall. The only thing I would give Travelers a tip my cap to is they've actually sustained a profitability over these 5 years. So and they have grown their profitability. So generally, I'd say that's better overall. And then lastly here, we'll look at shareholder equity. So once again, 30 billion for Allstate in 2020 down to 21. So kind of my takeaway, this video has been going on for an hour. I should probably wrap things up. Who knows if anyone's actually listening at this point, but what I'm going to do is actually give props to Travelers, and we can compare it to Progressive, which is another insurance company that I already have on my list. But I think Travelers was solid enough that I think it's worth at least tracking, and then we can compare it to the other insurance companies that I track and see if it's worthwhile. That said, this is episode 2. I've been rambling on for a long time. If you're still here, that is freaking awesome. Really appreciate you and excited to see where this goes. But overall, happy with what we got covered today and can't wait for the next one.